In this video, we'll talk about percent-based revenue reallocation. This is a use case of a company where they're essentially selling two product lines, P1 and P2. For their P1 product line, they have a combination of hardware and software, plus they give away support free for the first year. For accounting purpose, what we will need to do is to carve out 25% of the total sale price between hardware and the perpetual license and allocate that revenue to the support. For the P2 product line, there is only a software perpetual license, and for that they need to carve out only 15% of their support of their revenue to the support line item. So what I already have in the system, as you can see, are 5 products: a P1 hardware, P1 perpetual, and then followed by a P1 support, which is only there for the accounting purpose. It will not exist in the actual contract. Also, for P2, we only have the P2 perpetual, which essentially means that for this product line, they're only selling the software. And we also have P2 support, which we'll use for allocation of 15% of the revenue. Next, what we'll show you is I have standalone selling price rules for each of these product lines. As you can see, for hardware, we're using the sale price as a standalone selling price. Similarly, for the software, we're using sale price for the standalone selling price. On the support line item on the other side, we have percent net base revenue allocation, and it shows us that it's going to be 25% of the related products. So for the P1 support, we want it to be 25% of the sum of the hardware and the software. If you click into the P1 support revenue item, you can see that when configuring this particular rule, we are actually setting the product type for both the products, hardware and software, as a related product type. That's how RevLock knows to calculate the percentage based on the combination of these two. Okay. Similarly, for the P2 product line, what they want to do is to carve out only 15% of this revenue. So that's why you see 15% here. And if I click into it, you see that the related product type is only one, which is P2 perpetual. Alright, now let's get started. We'll create a sales order in which we have these product lines. Let's add one. Let's create a new customer, Acme. Give it an ID 1. The order date is 15th of February 21. We'll give this order ID 1. And everything else is optional, so we'll skip to creating actual line items in this order. First, let's create an order with a perpetual license of product line 1. Let's say we sold quantity 1 at $15,000. Okay. For delivery, we'll keep the delivery date to be the date of the order, so that it makes it simple. What we'll do is we'll now add a hardware component to this order, which is P1 hardware. So we sold one quantity of it at $10,000. Again, we will not change the delivery date. We'll keep it to order date. We'll save it. Okay, we'll then add support line item to it. P1 support. Then we'll say the quantity was 1 and it was given away free as part of the contract. So that's why we put $0 unit price here. As you can see, it automatically brought up the term because that's what we set when we were creating this product. So it's an annual support item. Let's save it. Alright, so now let's briefly look at this contract. We have total of $25,000 sale, and the sale is between perpetual license of software and the hardware. Now let's go look at revenue arrangement and how RevLock actually processed this order. If you open it, so what we can see is the standalone price. There are 3 columns in this revenue elements expansion panel. First column shows you the sale price, the actual sale in the actual contract. In the second column, it shows the standalone selling price for each of these items. We set the standalone selling price rule for perpetual and hardware to be that the standalone price is the sale price. So that's why you see $15,000 and $10,000 here. For P1 support, we set it to the 25% of the total amount between perpetual license and hardware. So as you can see, it calculated it to be $62.50, which is 25% of 25,000 between 15,000 and 10,000. If we want to look into more details on how it calculated this number, you can simply click on this context pop-up, and then it will start showing you what calculation it did. So basically, you can see that the total contract price for this was $25,000. That's what it used to calculate the price range of $62.50 for this particular item, and that's what it allocated as the standalone selling price of the revenue. Now that we have standalone selling price for each of these items, we can see that the total amount is greater than the actual sale price, which is $31,250. RevLock will do the recalculation of the revenue based on the proportion of the standalone selling price in this number, and it will be back to the $25,000 of the total contract price. The reallocated revenue for support now becomes $5,000, and then the revenue for others are decreased slightly. Now that we have this revenue allocated, what RevLock does, it looks at the standalone selling price library and creates the revenue plans. So let's now look at the revenue plans. This is a graphical form. What we'll do is we'll switch to tabular form as it's easy to understand. We'll open all the items here. What it shows here is for the perpetual license and hardware, the revenue that got allocated was recognized point in time immediately, versus for the support, as the rule was to take the revenue ratably, it actually puts the revenue each month for the 12 months. One thing to note here is that first month is less amount, and this is because the start of the contract was mid of the month, so it had to prorate the revenue for that month. What we've seen here is an example where a product line which had multiple components sold, and then there is a revenue allocation to the support based on some percentage of the revenue. Let's talk about a little complex scenario now where customer can actually sell multiple product lines in one contract. So what we'll do is we will add a P2 perpetual license to this contract and see how RevLock can be used to carve out a different support percentage for different product lines. Okay, so we'll simply go ahead and edit this order, and we'll add a product called P2 Perpetual, one quantity for a discounted price of $5,000. We'll keep the delivery date to order date for simplicity. Save this. Additionally, what we'll do is we'll add another item here, which is P2 Support. And again, this was also given away for free as the P1 support. Let's set it to 0. We'll keep the delivery date as is, which is order date, and then based on configuration, it knows it's a 12-month term, so it comes up with the correct service delivery dates. We'll save this. Okay, so now let's briefly look at this contract. So in this contract, we have product line 1 perpetual license and hardware got sold, and the product line 2 perpetual license was sold. Support for both these items were given away for free. In our standalone selling price library, we actually set the rule for support for P1 to be 25% of the sale, versus we set the support for P2 to be only 15% of the sale. So let's see how RevLock processed those rules and come up with revenue for each of these items. All right. So again, back to the 3 columns. First is the actual sale price for each of these items. You have product line 1, 3 items for product line 1, and 2 items for product line 2. For product line 1, you can still see that it carved out $62.50 as a standalone price for the $25,000 collective sale of hardware and software. Similarly, For perpetual P2 or the product line 2 item, it carried out $750 for 5,000, which essentially is 15% off the actual price of the P2 perpetual license. If we open this context pop-up, you can actually see that configuration here, that for the 15%, it saw that the total sale for this product line was $5,000 only, and it included only that in the calculation, and that it comes up with 15% standalone price range, and finally calculates it to be $750. So that's how. So as you can see, RevLock almost created simple grouping when creating these reallocations of revenue between the product lines. And then once this is, it has established standalone selling price, it applied the same proportional reallocation of revenue method so that it comes up with this number and bring down the whole contract value to $30,000. Again, we'll quickly look at the plans. If you open the support items for both of these plans, they're both ratable. As you can see, there's a smaller number for P2, it was sold for the less price. Also, for all the hardware and software sales, everything is actually point in time, upfront. You can see that the revenue was taken upfront in February. Alright, so that's how revenue reallocation works in a complex situation where a contract consists of multiple product lines and needs different percentage allocation for each of these product lines. I hope I was able to explain this scenario. If you have any questions, please feel free to send a message, and then we'll be happy to respond to you. Thank you. Bye.